Good morning. Market Day Report is on the air. We're working our way towards the market open in about 15 minutes. Before that, let's check and see how markets traded in the overnight session. All right, we'll start with corn. A tick lower on the December contract at 418 and 3/4. What about soybeans in the overnight session? Well, beans settle overnight down, up to at 10.20 a bushel, and that's after being lower in the trade on Friday. Now, going into the session on Friday, beans had two winning streaks in a row. Had one winning streak with 2 days higher. Let's spit that out. And then a lower trade on Friday and a rebound in the overnight session. Wheat market, what's happening there? Well, wheat up a couple of pennies in Chicago at 517 and a quarter, just a tick off the day's or overnight session high. Hard red at 499, same story there, up 2 pennies. Spring wheat contracts overnight, mostly higher, and the cotton market up 11 points at 65.41. Helping us break it down, he's the president of Midwest Market Solutions. It's Brian Hoops. Brian, I can't say anything. I was going to say no flash sales. It's just we don't know if there were any flash sales overnight because government shutdown.
Yeah, you're right. The government shutdown continues. It's going to linger here. They've already called off Thursday's WASD report. So, of course, you don't have the private sale announcements that we usually have in the mornings. Won't have weekly export sales. We won't have crop progress this afternoon. So we're really void of any information that's provided by the government this week. And it probably will be that way until the shutdown is averted. But we can find out some private information. We've talked about the old Sparks and Informa groups, now called S&P Global last week, lowering their corn yields, but StoneX, I think, increased their soybean yields. And information like that is what we'll be looking at and kind of trading off of. Some of the news wires are still going to publish their estimates for Thursday's reports. And they're going to get kind of a snapshot of what people are expecting based off of what they're hearing from farmers and customers. And our customers are kind of telling us that the corn yields are disappointing, but the soybean yields are there, and maybe in a lot of cases better than expected, certainly not in every case. We also have South American information that's being published, and their planting pace is off to a pretty good start, a little bit above normal. Winter wheat conditions in Argentina have been outstanding. And in fact, this news that's coming out of the world markets, a little bit bearish as far as our markets go, because we have a lot of world wheat production, no issues this year. A lot of the countries are going to have a lot of crop to export, which is going to hurt our U.S. exports.
You know, as you're mentioning all this, I thought might be a good time before we go to break to look at the dollar index as well. Simply put, with a lower dollar, a weaker dollar, if you will, ideally our commodities are a little more affordable to those who are buying. We're looking at December up 50 right now at 97.91. How is that dollar index factoring into maybe demand?
Well, yeah, you're absolutely right. When the dollar is cheaper, it makes our products appear to be a little bit less expensive, and vice versa. If that dollar starts to rally, it means our products will appear to be a little bit more expensive to these foreign buyers. So we're seeing a pretty sharp move today to the upside, which may slow down some of our export business. But this dollar index, like a lot of the grain markets, have been trending sideways, not much of a pattern one way or the other. Now that it's expected, maybe the dollar will start to strengthen a little bit as we go into the harvest time frame. That would undercut some of our export markets, and we're really heavily dependent upon corn exports this year. We have a huge supply. We know we're going to have huge supply here in the United States, a lot of production, so we need a lot of exports. USDA is forecasting record amount of exports to get through some of this crop, along with feed usage and ethanol demand being at near record highs.
Yeah, that dollar index was lower on Friday, and year to date is down about 10%. We're talking with Brian Hoops, Midwest Market Solutions. We've got a quick break, and on the other side, we'll talk cash cattle trade. Market Day report continues in a moment. So we're watching pressure in the cash trade. Okay, we'll talk about actual cash trade in just a moment for the North, the South, and dressed. But what about live cattle? How did we close out the session on Friday? Well, 50 higher on the October at 231.02, and the December buck 12 higher at 234.60. Now over to feeders, which on Friday settled in higher territory. After 2 straight days of losses, the feeder market settled Friday at 357.07, up 277. 307 higher on the November at 355.47. Pretty tight ranges, though, in trade on Friday. Hogs higher as well, breaking a 4-day losing streak as the December contract settled at 87.30, up 62. Brian Hoops, President, Midwest Market Solutions, cash trade. What happened?
Yeah, we were a little bit softer. Some of that cash trade occurred well after the board was closed, so we may give back some of the gains we saw on Friday as the 233 was traded in the Southern Plains about $2-3 softer than the prior week. We did see earlier trade in the week in the North. That's right at 230 and about 359, 360 on a dress basis. So those are down $5 to $6 from the prior week. So overall, just a soft cash markets, which really isn't a surprise given our weak undertone of the cutout values. They continue to weaken, continues to put red ink on the Packer margins. In fact, choice was down almost $10 again last week, and it has fallen over $51 since the beginning of September. So we've really lost a lot of ground in these cutouts. And Packers surprisingly have not really cut kills very much in an effort to prop up these boxes. They did lower kill maybe 4 or 5,000 last week compared to the prior week, but that's really not enough to even stabilize or turn these boxes back higher. So a lot of anticipation, a lot of hopes anyway, that we're nearing the bottom in the cutout values and they'll start to stabilize to move higher. Until they do, the cash markets are going to be under some pressure. Of course, Oklahoma City auction, early parts of this week will be really closely watched. That's going to give us direction for those feeder cattle futures. If the cash markets there can stabilize, we could have another push higher in the feeders. But same token, weakness in those cash markets going to keep pressure against our futures contracts.
Oh, hey, Brian, I'm thinking out loud here. Could we see lower kills this week just based on Cargill closing down that plant in Fort Morgan, as they've closed that one down for some maintenance? I think it's down for, what, 2 weeks or so? Could this be an opportunity for Packers maybe to move back into the black?
Yeah, they always schedule those maintenance downtimes when their margins are deeply in the red, coincidentally. So it's never when they're really making a lot of money on their kills. But yeah, this comes at a time where they can afford to be shut down. They probably want to be shut down so they're not killing as many cattle. That could help our boxes a little bit to firm up. But certainly, yeah, it's going to affect our cash markets as they don't need as many cattle to kill. It'll keep a little bit of pressure on those cash markets.
All right, Brian Hoops, Midwest Market Solutions. We'll see him back here on Wednesday.